What's up, millennials? In this video I'm going to give you the exact valuation of Romeo Power Technology, which is the company that's going to be acquired by RMG Acquisition Corp, which so far is trading under the ticker symbol RMG. Now, a little spoiler alert, because according to my calculations there is still a lot of room for upside. Now, if you would like to have some more examples of the valuation method that I'm going to show you today, you can check out some of my previous videos. I've done a similar video about GMHI, Gore's Metropolis, which is the company that's going to acquire Luminar. And I've also done a similar video about Switchback Energy, SBE, which is the company that's going to acquire ChargePoint. But before we begin, a few things first. First of all, if you haven't seen my stock o'clock videos yet, these are daily short videos of 1 minute with stock market news, then definitely check those out. Secondly, apart from the valuation calculations that I'm going to show you in this video, I haven't done a lot of research on this company, on Romeo, just yet. I am mainly doing this because there were several subscribers asking me in the comments to do a valuation video about this company. And third, I'm still not a financial advisor, so all the calculations and all my thoughts in this video are exactly that. These are thoughts that are expressed by a random dude on the internet. Alright, with that being said, let's get started. Alright, the first step that we're going to take is to calculate the current pro forma market cap and also the current pro forma enterprise value. So what does that all mean? Well, we're going to use a few things. We're going to use the investor presentation that was provided to us by Romeo and by RMG Acquisition Corp. And we're going to use also an Excel sheet that I created myself, alright? So we see a few things in the investor presentation. First of all, they use a base share price of $10 per share, okay? And they're saying that after the merger happens, there will be 134.4 million shares outstanding. So there we have already a few important data, because we have a share price of $10 and we have an amount of shares of 134.4 million. That means that we can already calculate the market cap, okay? Because the market cap is basically the amount of shares multiplied by the price per share, right? So what we do is simply multiply $10 by 134.4 million, and then we're gonna get a market cap, or in this case, what they call in the investor presentation, an equity value of around $1.3 billion, okay? And then something else is important as well, because as we can see in the investor presentation, they are going to have an amount of cash on their balance sheet. And in this transaction, in this merger, they are going to have $351 million in cash on their balance sheet. So I've put that in my calculator as well, in my Excel sheet as well. Now, to determine the enterprise value, we basically need to take the market cap and subtract the amount of net cash to get the enterprise value. So that is basically the value of the company itself, of Romeo, right? The company that is going to be acquired. So we take that market cap that we just calculated, the almost $1.3 billion, and we subtract the amount of net cash that they're going to have on their balance sheet. And that leaves us with an enterprise value of almost $1 billion. So the current pro forma market cap, based on a base share price of $10, would be $1.3 billion, and the pro forma enterprise value would be almost $1 billion. But the thing is, if we go into TradingView, we see that the share price of RMG has increased to $15.70. Let's take that number, okay? And let's go back here. So $15.70. That is the current price per share. So that means that the pro forma market cap has also increased by, in this case, 57%, right? So what we now need to do is we need to multiply the same amount of shares that we have are outstanding after the merger, so still 134.4 million, and now we multiply it by the price per share of $15.70, which is the current price per share. And that gives us a pro forma market cap of $2.1 billion And if we subtract the amount of net cash, it gives us an enterprise value of almost $1.8 billion. So those are based on the current price per share of RMG. Those are the current pro forma market cap, yeah, right, the $2.1 billion. And the current pro forma enterprise value is $1.8 billion. Then step number 2 is going to be to calculate the future enterprise value. So the future enterprise value now. And the investor presentation of Romeo and RMG doesn't give us exact numbers about the future enterprise value. So what I'm going to do is I'll use the numbers from QuantumScape, which is a similar company that actually just went public via a SPAC merger as well. So to determine the future valuation of Romeo, we are going to use the same revenue multiple of 5 to 9x, which we can see over here, that was used to value QuantumScape, okay? So 5 to 9x. Using this number, 5 to 9x, the revenue multiple, is one of the methods to determine how much a company is worth in the future, right? So based on the amount of revenue that a company is expected to bring in the future. Now, in the case of QuantumScape, they said, all right, in 2028, so in about 7 to almost 8 years' time, we are going to have a revenue income of $6.439 billion in revenue, okay? Now, if we remember the multiple numbers of 5 to 9x, we can say, okay, so with a multiple of 5, we can multiply 6.439 by 5, and then we get a low valuation of $32 billion more or less. And if we then multiply that same number, 6.439 by 9, we get a high valuation of $57 or $58 billion more or less, right? And they actually, if we go back to page 31, we can also see these exact numbers represented here, the future enterprise value between $58 billion and $32 billion. So we are actually going to use the exact same revenue multiples of 5 to 9x for the company that we are going to talk about today, Romeo. However, Romeo doesn't provide revenue numbers for 2028. So what we are going to do is we're going to use the projected revenue of 2025, which, as we can see in this row over here, the total Romeo revenue in 2025 is $1.65 billion. Okay, so let's put that in our calculator, 1.65. And let's first multiply it by the first revenue multiple of 5x, right? The first multiple value of 5x, that would be $8.25 billion. So that's the number that I've put in my Excel sheet as the low future enterprise valuation of Romeo, okay? 8.25 billion. And then if we take the same amount of revenue, so 1.65 again, and times 9, the other revenue multiple that we saw with QuantumScape, we get a valuation of $14.85 billion in the future, so in 2025. That would be like the high valuation, so to say. And I'm actually going to add another valuation, which I'll call the midpoint valuation. And that is simply the average of the low and the high valuation. So we saw that we had a low valuation of 8.5, a high valuation of 14.85. We're going to divide that by 2, and then we get a midpoint valuation, an average valuation, if you will, of $11.55 billion in enterprise value. Then step number 3 is going to be to calculate the discounted enterprise value. So we now know the future enterprise value, or at least the projected future enterprise value, and now we're going to discount it back from the future to the present. And as we can see in the investor presentation of QuantumScape, they used a discount rate of 20%, which is right over here, 20%. So we are also going to use that same discount rate of 20%. But instead of discounting it back 7 years, we only discounted 4 years back. Because remember, we were looking at a projected revenue of 2025 instead of 2028, which was the year that was used in QuantumScape's investor presentation. Okay, so we are going to do it 4 years back. And we have a formula for that. First of all, let's go back to the valuations that we have calculated in step 2. So we had a low enterprise valuation of $8.25 billion. Now, what we need to do to discount it back 20% for 4 years, 4 periods, is to divide it by 1.2. The 2 stands for the 20% in this case. And we need to do that to the power of 4 because we are going to calculate it at a discount rate of 20% 4 years back. And that gives us an enterprise valuation of almost $4 billion. So in this case, $3.979 billion, which again is the low discounted enterprise value, okay? 3.979. Let's do exactly the same for the high valuation, right? So we had a high valuation of $14.85 billion, the future enterprise valuation. We're going to use the same calculation, the same formula. So dividing it by 1.2 because of the 20% discount rate. And we do that for 4 periods. And then we arrive at a discounted enterprise value of $7.161 billion. So almost $7.2 billion, right? And well, for this as well, we're going to calculate the midpoint valuation, which simply is going to be to add these two together, 3.9 and 7.1, divide them, and then you're going to get a midpoint fair value of $5.6 billion, more or less. Step number 4 is going to be a little bit easier because that is going to be to calculate the fair pro forma market cap. And that is quite easy because the only thing that we need to do right here is to add the amount of net cash on the balance sheet on top of the discounted enterprise value. So we've now calculated that the discounted enterprise value, the low enterprise value, would be almost $4 billion. Then we would need to add the amount of cash, so $350 million more or less. That is going to give us a pro forma fair market cap, so to say, of around $4.3 billion. That is the low variation. And then for the high valuation, we had calculated a valuation of $7.2 billion. We add the amount of net cash, $350 million, and then we get a pro forma market cap of $7.5 billion. And again, the last one would be the midpoint valuation, so $5.6 billion plus the amount of net cash gives you a midpoint fair valuation and fair market cap of $5.9 billion. And then the last step, step number 5, is relatively easy as well, which is going to be to calculate the fair current price per share. Now, as we've said in the beginning of this video, the market cap is the amount of shares times the share price, the price per share. We've already calculated the fair market cap for the low valuation, the high valuation, and the midpoint valuation. And we know the amount of shares that are going to be outstanding after the merger, which was 134.4 million shares, right? So the only thing that we need to do now is to take the fair market cap and divide it by the amount of shares. So divided by 134.4 million shares. So if we do that for the low valuation, we would take the market cap, 4.3, divided by 134.4 million shares. And that would give us a low fair value of $32.22. If we do that for the high valuation, we calculated a fair market cap of $7.5 billion. If we would divide that by 134.4 million, we get a high valuation of $55.89. And if we do the same thing for the midpoint valuation, we calculated that the midpoint valuation was $5.9 billion. So divide that by the amount of shares, gives you a price per share of $44.06. So the conclusion of all my calculations is that a fair midpoint price per share would be $44.06. And if you then take into account that the current price is $15.70, that would mean an ROI and a return on your investment of 180%. Now, before you sell your wife, sell your house, sell your car, and put all your money in this stock, please keep into account a few things, all right? First of all, I can be wrong. Never trust me, always verify me. And secondly, we use several assumptions from Romeo, RMG, QuantumScape. We looked at projected revenue numbers. we used a certain revenue multiple, we used a certain discount rate. Because if you change one of these numbers, then you're going to have entirely different calculations, and the fair price per share is also going to be entirely different. Third, always keep in mind share dilution. It might be the case that in some point in the future they add more shares. That leads to share dilution. What that means is that the market cap, the fair market cap, usually stays the same, but the amount of shares increases. And that means that the fair price per share is going to decrease. So always keep that in mind. Always look at companies adding shares, which leads to share dilution. And the last thing that I would like to tell you is that QuantumScape, as we speak, as I'm recording this video, is trading at a market cap of $18 billion. And RMG is currently trading at a pro forma market cap of a little bit more than $2 billion. So yeah, just to let you know that, and also to let you know my personal opinion, which is that QuantumScape is relatively overvalued and RMG or Romeo seems to be a little bit undervalued. So yeah, that's just my personal opinion, just a random opinion from a random dude on the internet, not financial advice, of course. Okay, so before you leave, let me know in the comments, what is your opinion on the current valuation of RMG? And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye!